All right, guys, Kenny Stigler Mortgage, welcome. This is actually going to be the first of a series of training videos designed for loan officers who are just starting to get into business, or even people that have been in the business for a while and have never been really formally trained on the system that I use here at the office that I developed for my LOs, and in terms of the way that I get them trained up. Okay. For the most part, and then this is kind of the reason why I believe it's so important. Your average loan officer in the business right now has a 70% closing ratio, right? That means 3 out of every 10 deals that they submit to a bank end up falling apart for one reason or another. And when you study it and you try to figure out, well, why is that happening? You'll come to find out that the majority of the mistakes that are being made are typically in the income qualification part of the whole thing. On the basic level of trying to figure out what is the qualifying income of the borrower. The majority of mistakes are made right there. As an LO, if you're trying to build your business the way that I train here, which is by referral, so that people are actually bringing you their clients as opposed to you being what I call a customer getter, you have to be an LO that basically closes 99.9% of your transactions. You have to be known as a closer. So you cannot make those kind of mistakes that your average loan officer makes. Because the second that you make one mistake and one person doesn't qualify, after you already told them that they did, whoever brought you that client, which most of the time is a real estate agent, you're probably never gonna see them again. They're never gonna wanna talk to you again. That client's probably mad at them because they referred him to you. So you can kind of get the idea, right? You're not going to be able to build your business up by referral unless you're a 99.9% closer. This is the reason why I spent so much time on what we're about to do here, which is income qualifying. So this system of qualifying clients that I've created, it comes out of necessity for this, right? Besides the fact that I train my guys to be 99.9% closers. Believe me, the hardest part about this business is getting clients, okay? If you're always focused on getting clients, being a customer getter, right? You're always passing out flyers, making cold calls, going to open houses, advertising. This business isn't that much fun. You're always struggling trying to find out where your next paycheck is coming from. You're always focused on getting customers. And the second that you stop doing that, your business starts to go down. It's a lot more fun to do this business when people want to bring their customers to you, or customers come to you on their own, right? Because they're counting on you for being a closer. Typically when I meet a client for the first time, it's usually on a Saturday morning. The real estate agent that knows me is like, hey Kenny, I have a client that wants to come in. I'd like to get them pre-approved so I can go show them some houses today. In a lot of places, what usually happens is they gather up all the customers' information and then they basically give it to what they call in most places a loan officer's assistant, who will crunch the numbers and get them back to an answer, usually 2 or 3 days later. They'll run the DU, all that stuff. The bad part about that is like, what if your customer wants to go out and take a look at houses that very same morning? I want to be able to give them an answer right away. I don't want 3 or 4 days to pass by before I give them an answer. I want to give them an answer right now. And I want to give them an answer with 99.9% certainty that that deal is going to be able to close. I say this a lot, but I pride myself in training my guys to the point that the only excuse as to why a deal didn't close that I already pre-qualified is if that customer lost their job or passed away. There's no other excuse. If I pre-qualified somebody, if one of my guys pre-qualified somebody and I said that they're going to qualify for a $400,000 house or a $500,000 house, it's because it's going to happen. As long as they don't lose their job, as long as they don't die, that deal is going to close. I'm not going to have any excuses. And the agent doesn't expect any excuses. The client doesn't expect any excuses. Nobody expects any excuses. So I've devised this system where I can meet that person on a Saturday morning, spend a good 45 minutes with them, going over all the numbers, and being able to hand them a pre-approval letter on the spot, and they can walk out of my office and go look at some houses and hopefully make an offer on it. That's the goal of this system that I'm about to show you guys. That's the reason why I came up with it, is you want an on-the-spot answer with 99.9% certainty that you're going to be able to close that loan. Right, we're going to get into more stuff as these video series go along, but we're going to spend a lot of time, what I do here at the office, on income qualifying. And I've done it so much that I was like, you know what, I'm just going to do a video about it so that I can just tell everybody just to watch that. I'm like, you will learn how to be 99.9% closer if you watch these videos. Even if you end up not coming to work with us, you can use this in your own business, and I promise you it's going to take you to another level. So, that being said, let's get started. The first question I typically ask people is, let's assume that you make 10 bucks an hour. If you show up to work every day and you work 40 hours a week, how much money do you make in a month? All right, stop right there. Stop the video for a second, okay? I don't know how I forgot to talk about base pay, because I always talk about base pay in all my classes, but for some reason in this video, I forgot to talk about base pay. So we're gonna cut right now and we're gonna talk about base pay. So what is base pay? It's something that we're gonna be talking about over and over and over again. That's why I can't believe that I forgot to talk about it. And you're gonna be needing it in your career, right? It's like, you're gonna be focusing on what's base pay all the time when you're qualifying somebody. Basically, what is base pay, right? Base pay is the amount of money that somebody's will make in a month if they just show up to work and work all their hours like they're supposed to. So for an hourly employee, it would basically be, you know, how much money they make in a month if they just show up to work every day, work their 8 hours a day, 5 days a week, basically 40 hours a week. And how much money they make in a month, that would be their base pay, right? Somebody that is a salaried worker, their base pay would be their salary, right? The amount of money they get just for being employed. It's their guaranteed money. That's another way of thinking it, is what's their guaranteed pay, right? The bank really wants to know that. What's the amount of money that they're gonna make just by showing up and working their schedule like they're supposed to. Base pay does not include overtime, does not include commissions, does not include bonuses or anything like that, right? All that type of income is not really guaranteed income, right? You don't know how much overtime you're gonna make. You don't know how much bonuses and commissions you're gonna make. That's why it's not included in base pay, right? It's not your for sure income. So if you wanna think of what base pay is, think of base pay as your for sure income. You just show up to work and work your schedule like you're supposed to. Your 40-hour work week, right? How much money you make in a month? That is your base pay. All right, back to the video. The first question I typically ask people is, let's assume that you make 10 bucks an hour. If you show up to work every day and you work 40 hours a week, how much money do you make in a month? 8-hour work days, 40 hours a week. If you make 10 bucks an hour, how much money should you make in a month? Why don't you pause and think about it for a second and write down your answer, and then we're gonna go on to the next step. So, most of the time, I hope this wasn't you, this is the answer I get. 10 bucks an hour times 40 hours a week. That's 400 bucks in 1 week. Well, there's 4 weeks in a month. Right, so times 4, he makes $1,600 a month. That's their answer. Unfortunately, if you got that, that's the wrong answer. Okay, it's not 1,600 bucks a month. And if you did that, you would have shortchanged your client, and I'm gonna show you why. Up to here, it's correct. All right, it's $10 an hour, 40 hours a week, that's 400 bucks a week, except that there's 52 weeks in a year, right? 400 times 52 is 20,800. And then it's how many months are in a year, because this is how much money he makes in a year. 20,800 divided by 12, and he really makes $17.33 and 33 cents per month. That would be the correct answer. So if you would have given them $1,600 a month, you would have shortchanged them by about $133, right? That would be the wrong answer. We don't want to do that. So that's just the basic right there, right? A lot of people get that wrong for some reason. Very important to calculate that there's 52 weeks in a year. Not every month has 4 weeks, so doing it like times 4 would be the incorrect answer. When we try to calculate income, we're always trying to figure out how much it is per month, all the time. So the first question that you want to ask when you're qualifying somebody, numbers-wise at least, is what is their base pay? Before we move on to anything else, we need to figure out what is their base pay. Because then we have to figure out if they're making their base pay right now or not. That's very important. We'll go into that more in detail, but let's just figure out base pay first, okay? If somebody makes 15 bucks an hour, what is their base pay per month? If you guys remember the example for the $10 one, you should be able to kind of figure this one out now. All right, so let's just pause for a second, see if you can do it. Figure out what is the base pay per month for somebody that makes 15 bucks an hour, assuming that 40-hour work week. Let's find out if you got the right answer, okay? So somebody that makes 15 bucks an hour, they work their 40-hour week, okay? And then we know there's 52 weeks in a year. Okay, that should tell me how much money they make in a year, what their base pay is per year. 15 times 40 times 52. This person has an annual base pay of $31,200. Okay, and all you got to do from that point on is now just divide it by 12 so that we can see that they make $2,600 a month base pay. I'm very particular about units. If you're just starting to learn this, it's really important to keep track of the units, okay? So back to this, 15 bucks an hour, base pay is 2,600 bucks a month. Very important that you can be able to do that. If somebody makes $1,000 on salary and they're being paid bi-weekly, bi-weekly means every other week. Okay, that would mean 26 pay periods. That's $1,000 times 26 pay periods. All right, that means bi-weekly, once again, every other week. This person makes $26,000 a year on base pay. If this happened to be bi-monthly, okay, that same $1,000 is now times 24, right? They're getting paid twice a month. So now they only make $24,000 a year. So when you're looking at that pay stub and they tell you that they're on salary, $1,000 per paycheck, it's very important to figure out if they're bi-monthly or bi-weekly. Let's start off with our first actual scenario. I'm gonna put a scenario on board and we're gonna figure out what this person's qualifying income is going to be. That is the goal of this lesson, is for you guys to be experts at figuring out what the qualifying income is. I'm gonna tell you, most loan officers out there have such a hard time doing this with consistency, right? This is the basis of most errors out there. It's the reason why most loan officers have a 70% closing ratio. All right, I want to get you guys at 99.9%, all right, and just figuring out this really simple thing, just focusing on qualifying income is going to really get you there above and beyond anybody else. There is a process that I use, all right, and we're going to go over it. I have a PDF flow chart, step-by-step instructions as to how you qualify somebody, how you income qualify somebody. I can email it to you. Just text me your email address to 909-948-1417. I'll have it here on the screen, and I will send you a PDF copy of the flow chart that we use here at the office. But let's go over our first scenario. Let's pretend we have a client that walks in and we're meeting them for the first time, and I'm looking at their pay stubs. All right, I always tell people to bring me, at the bare minimum, so I can figure out what their income qualifications are, is their pay stubs for a month and their W-2s for the last 2 years. So the last 30 days of pay stubs and the last 2 W-2s. That's if they have a job. So let's just pretend they have a job right now, okay? Which is the majority of people you're gonna encounter. I can look at their pay stubs and I can see that in this example, the person makes 20 bucks an hour. I can get that from the pay stub. So the next thing that I wanna do, once I figured out how much money they make per hour by looking at their pay stub, is figuring out how much money they've made so far this year. And what I'm focused on is their gross income. I wanna know how much money they made so far this year, gross. Gross means before the taxes have been taken out. Before the federal and state taxes, all that withholding gets taken out, that is the gross income. Net would be the money, the take-home money, how much money they actually gets deposited to their account, right? The amount of money that actually gets written on the check, that would be their net. But what we're focused on and what we qualify people on is based on their gross income. Anybody that has a job is qualified based on their gross income, which is different than somebody that would be self-employed. They would be qualified under net income. Let's take a look at this guy's pay stub, right? How much money have they made so far this year? Okay, I take a look at the most recent pay stub in this example, and that pay stub has a pay date of June 5th. That's the date that I'm looking at, not the ending pay period, okay? I'm looking at the pay date. It's very important. For example, let's pretend that somebody is working on their last pay period of the year, right? December 15th to the 30th. Usually they would get their check, if they worked from the 15th to the 30th of December, they wouldn't get their check until like, a few days later into January. It could be like January 5th. Does that income count for the previous year's income or the new year's income? It obviously counts for the new year's, okay? Because it's very important when they receive the money. We count the income for the current year based on when they receive it, okay? So when you're looking at somebody's pay stub, pay attention to the pay date, okay? So I'm looking at this person's most recent pay stub. It says what their year-to-date income is as of that pay date, all right? And in this example, the year-to-date income happens to be as of June 5th. And in this example, it's going to be $21,000 gross. $21,000 gross so far. I can get these two pieces of information just from looking at the pay stub. $20 an hour and $21,000 a year so far this year as of June 5th. The next thing that I'm going to look at is their W-2s for the last 2 years. And I need to find out how much money it shows that they've made on their W-2s. And in this example, I look at this person's W-2, and in 2020, they made $43,000, and in 2019, they made $42,000. Okay. This is the setup for this client. Okay. This is all the information that you really need right now to income qualify them. All right. Pay stubs, W-2s, if they happen to have a job. The first question on the chart, on the little flow chart that we use here at the office, are they making base pay right now? I need to know if this customer has been working all their hours so far this year. Because if they have, that would mean that yes, they're making base pay. So I need to know, number one, what is their base pay per month? I think you guys have already had a little bit of practice on that, but let's do it here, all right? I need to know how much their base pay is per month, and then figure out how much money they should have made by now, by June 5th. And then I can compare it to what they actually made, and I can answer that question, are they making base pay right now? So first things first, let's figure out how much their base pay is per month, right? 20 bucks an hour, 40 hours a week, times 52 weeks in a year, and that's gonna tell me that their income is per year $41,600. Okay? All I gotta do then is divide it by 12. And that's gonna give me a monthly income of $3,466.67 per month. This is their base pay. Once again, the amount of money that they make per month if they just show up to work every day like they're supposed to and work their 8-hour shift, 5 days a week. Base pay. I need to know how much money they should have made by now, June 5th. So basically, this amount of money, $3,466.67, times how much time has gone by. Well, June 5th happens to be how many complete months? January. All of January, all of February, all of March, all of April, all of May. 5 complete months. So I'm gonna put a 5 here. Some people like to say 6 when they see June, but it's not. We do not have 6 complete months. We only have 5 complete months and 5 days. It's June 5th. What do those 5 days mean? Well, if it's 30 days in a month, and that's what I always assume when I'm doing my calculations, right? It's 5 days out of 30. When you punch that into your calculator, it's going to give you a decimal. 5 divided by 30 is 0.1666, right? I always estimate to 3 digits when I'm doing numbers that are not dollars. So 0.166, this number is 5 or higher, so it's going to round up. So I'm going to use 0.167. I'm going to round that number up. So now if I take this number and multiply by that, this is months, it should tell me how much money he should have made by now. 17,912 and 28 cents. This is how much money he should have made by now if he just showed up to work every day, 8 hours a day, 40 hours a week like they're supposed to. How much money did they actually make? It looks like they made actually $21,000. This is how much they should have made at least, but they actually made this by looking at their pay stubs. So what could have happened? Why is the year to date showing $21,000 on their pay stubs, and we know that the base pay is $17,912? Well, think about it. He could have worked overtime. He could have had some bonuses. He could have had some commissions. There's other income that could possibly be in there, right? That's making it so that his year to date is actually higher than just his base pay income, which is lower, right? We want to be able to use that income for qualifying purposes, because obviously if a client, the more income that a client has, the more they can afford, the more they can qualify for, right? But we have to be able to justify it to the bank. It can't just be because he had a good month. So typically, if you want to be able to use income that's beyond just their base pay, you have to be able to show a track record of him receiving it. It can't just be because, oh, he had a really good month last month, or last month he worked a lot of overtime, right? There has to be a period of time that we can show consistency of them receiving that extra income. Normally, the correct way of doing it precisely would be to order what's called a verification of employment. We basically send a letter to the employer so they can break down how much of their income for the past 2 years, year to date and the previous 2 years, how much of that is base pay, how much of that income is overtime, how much of that income is commissions, how much of that income is bonuses. Because anything else that's not base pay, we would have to average it out, typically over the last couple of years, one at a time. How much we're gonna average out, we would have to average out his overtime income. That would have a number. We would have to average out his commission income per month, average out his overtime income and bonus income per month. That's what you would actually have to do to get the most accurate answer. Of course, if you're trying to give somebody certainty on the spot, you don't have time to do that. This is the reason why we come up with this little chart that we're working off of, because it's gonna allow you to give them an answer on the spot and still be 99.9% accurate. Worst thing that could happen down the road is, let's pretend you get into escrow and they actually order the VOE, and you'll find out what his income breakdown actually is at that point. You're never gonna overqualify somebody. You might underqualify them by using the way that I do it, but you'll never overqualify them. So you're never gonna come in like in the wrong, basically, right? You're never gonna tell somebody that they qualified for 500 and later find out that it was actually 480. Okay, it might be the other way around, which is good, because you never wanna be on that end where you have to tell somebody that, oh, oops, I didn't qualify you the right way. This person has more income than what they should have made. So possibly, we don't know what it is. Actually, we do know. It could be, you could be overtime, commissions, bonuses, right? That's on his pay stub. It'll show you a breakdown right there. But will we be able to use that income? For that, we have to average, okay? The chart is going to tell you whether you're going to do a 24-month average, a most recent 24-month average, or a year-to-date and 12-month average. Those are the only two averages that we use. A most recent 24-month average, or a most recent, or a year-to-date and 12-month average. If you follow along on the chart, when you answer the questions, it'll tell you which one of those averages to use, and that's how you're gonna come up with their qualifying income. The first question was already answered. Are they making base pay right now? The answer is yes. They made $21,000. That's more than base pay. They're at least making base pay right now. So the next question that the chart's gonna ask you if you follow along is their income increasing or decreasing? And it's talking about year over year income, right? It's asking us to look at what their W-2 income is for the last couple of years. Has their W-2 income gone up? Is it going up or is it going down? In this particular example, we see that his 2020 W-2 is showing $43,000. The 2019 W-2 is showing $42,000. His income is increasing year over year. 2019, $42,000, 2020, $43,000. It's gone up. So you're following on the chart. We've already said his income is increasing. The next question is, did they make more than their base pay last year? We know that base pay income is $41,600. We did that by multiplying 20 times 40 times 52. It's $41,600. Did they make more than base pay last year? Well, last year they made $43,000 in 2020. $43,000, that actually happens to be more than the annual base pay income of $41,600. So the answer to that question is yes. So moving along, it tells us that we need to use a 24-month average. So how do we do that? So the chart says we need to do a 24-month average. By the way, guys, the chart, I always liken it to a recipe. Okay, when I'm training you guys for the first time, think of the chart as a recipe. If you've never baked a cake in your life, and I said go bake a cake, who knows what we're gonna get? It might not even be edible. But if I gave you a recipe, even though you've never done it before and you don't even know how the ingredients even go together or anything like that, if you just follow along step by step, it's gonna come out pretty decent the first time. It's gonna be edible. This is exactly what this chart does, all right? As a new LO in the business, you might not understand why we're doing it this way, but you're gonna get the right answer. You're gonna get the right answer the first time. You're gonna get the right answer the same way that a 10-year veteran is gonna get the right answer. You might not understand why, but you will get the right answer, okay? So back to the chart. It's asking us to do a 24-month average based on the way that we answered all the questions, okay? So let's do that for our example here. I always tell everybody to start off with making this little T-chart. I pride myself on being able to teach my guys to do this on a napkin, right? To be able to qualify somebody on a napkin with like 99% certainty. Really simple stuff here. On one side, I want you to put dollars. On the other side, months. Okay? Remember, we're doing a 24-month average, a most recent 24-month average. So let's start with the current year. It's June 5th. How much time has gone by? We already wrote that down the first time, right? It was 5.167 months have gone by this year. And in those 5.167 months, how much money has he made? You look at the pay stub. The year to date shows 21,000. So you're right, 21,000. So we did this year. Let's work backwards. Last year, how many months were last year? Well, last year had 12 months. 12.0 months. And in those 12.0 months of last year, how much money did they make? Taking a look at the W-2, $43,000. You'll see this is pretty easy, guys. Just work yourself backwards. Okay? Now the next step. Sometimes people get a little tripped up here. Remember, we're doing a 24-month average. Most recent 24 months. 24 months. We got 5.167. We got 12. How many months are missing so that it adds up to 24? You pull out your little calculators. Got mine here. I'm going to start backwards. 24 minus 12 minus 5.167. I still need another 6.833 months of 2019 income. So how much money did he make in 6.833 months of 2019? A lot of people get tripped up here, but it's pretty easy. First, figure out how much money he makes per month on average in 2019. So you take your $42,000 that you made there and simply divide it by 12. Happens to be $3,500. So on average in 2019, he makes $3,500. I need to know how much money he makes in 6.833 months of 2019 income. So I just take that number and multiply it by 6.833 months. That happens to be $23,915.50. Let me get this out of the way now. Now all you gotta do, like we did on this side, we add this up, should add up to 24 months, because that's what we're doing. Add up all the money that he's made in those 24 months, and you should have $87,915.50. And all you gotta do at this point to get an average is how much money they made in 24 months, divided by 24 months, and that's gonna give me $3,663 and 1458, which I'm gonna round out to 15 cents. This is his 24-month average income, $3,663.15. Do you guys remember what base pay was again? Let's take a look at it again. 20 times 40 times 52 divided by 12. Base pay per month was $3,466.67. Notice how doing the average of 24 months yields a higher number than just base pay. There is evidence here, a 24-month track record, that this customer makes more than just base pay. That is what we needed to show the bank. We needed to show the bank that on average, he's making this much money, and we have a 24-month track record to prove it. That's stability. And because we have that, we're now able to use a higher number than just base pay. By the way, guys, once we answer this question, the first question on the chart, as a yes, that yes, the customer is making base pay right now, no matter what happens, we will not assign to them a higher qualifying income than base pay once we've already said, yes, he's making base pay. All right, stop the video again. Stop the video again. What I meant to say was that once we've determined that the customer is making base pay, once you've answered yes to the very first question on the chart that he is making base pay, then no matter what happens with the averages, okay, no matter how the averages work out, we will never assign to him a qualifying income that is less than base pay if you've already determined that he's making his base pay right now. The only possible thing that's going to happen is if by doing the averages, that number ends up being higher than base pay, then you will use that number. But you will never give him a qualifying income that is less than base pay if you've already determined that he's making base pay. All right, back to the video. Which is why on the chart, it asks you right after this, is his average income less than base pay? Because if his average income happened to be less than base pay, you would just stick with base pay. But in this case, his average is bigger than base pay, so guess what? You get to keep his average. It actually helps him out. And that would be answering the last question, and we're done with that. We have figured out what his qualifying income is for purposes of qualifying for a loan. And you can use this number with 99.9% accuracy, okay? Now keep in mind, it's not the official number, because in order to know what the official number is, we would need to know a breakdown of his overtime, commission, bonuses over a last 2-year period, year to date and the last 2 years. But when you meet with them for the first time, you won't have that information, so you cannot know that, right? Which is why I've devised this system, once again, to do it this way. If anything, you might underqualify somebody, but you will never overqualify them, which is bad. If you underqualify them by a few $1,000s, oh well. You were able to get them out the door and looking for houses right away, okay? Knowing full well that you'll never have to tell them or the agent that brought you that client that they don't qualify down the road once you get that VOE.